Singapore's Finance Minister has wrapped up the two-day budget debate in Parliament. He said cutting the goods and services tax is not the right solution to tackle the rising cost of living. And he reiterated how a new $3.2 billion help package will aid those who need it most.
The widening income gap and rising cost of living are issues close to the hearts of Singaporeans. And the Finance Minister says the Grow and Share package is timely.
We are providing more than required to offset the entire increase in cost of living that low and middle income households will face this year.
For a retiree household in a three-room flat, expenses are expected to go up by about $400. But they will receive more than 6 times that amount in transfers. Likewise, a low-income household with 2 children will receive about 5 times more than the increase in cost of living this year. A 3-generation middle-income household will get 1.8 times more. The Finance Minister also noted that the opposition MP Lau Chia Kiang had dismissed all that the government is doing in this year's budget to help families offset the cost of living. Instead, his solution to the rising cost of living is to reduce GST by 2 percentage points and to waive GST for basic necessities.
It seems to me that this government using GST, look at GST as panacea to everything, of income to help to provide, to help the lower income.
Explaining why that's the wrong solution, Mr Tharman said the bulk of GST collected came from higher income groups and foreigners. In fact, in 2010, the bottom 20% of households contributed only 4% of all GST paid. The bottom 60% paid about 16%.
It's a trade-off which any opposition has to address. The alternative policy cannot be about giving more and more. It also has to say where you're going to get the money from. And in your case, you're going to take less money from the rich. You have to explain how you're going to give more to the poor. So we don't see the GST as a panacea.
Mr Tharman said the lasting solution to inflation is to raise incomes across the board. And key to achieving that is education, particularly investment in early education, as it reduces the disadvantages faced by those from low-income backgrounds. Next is promoting training and upgrading to ensure no one gets stuck in a low-end job. But he said productivity improvements will not be realized if firms continue to rely on low-cost foreign labour. Hence the increase in foreign worker levy, as it's better to introduce a gradual increase when the economy is strong.
Well, companies in Singapore now have more incentive to innovate and become more productive. The Finance Minister says the government will allow a 1-year tax deferral under its Productivity and Innovation Credit or PIC scheme. This will help businesses avoid cash flow problems while making investments under the scheme.
Finance Minister Tharman Sharnmugaratnam says that's for up to 100,000 of qualifying PIC expenditures in the current year. The same amount of tax can be deferred to the next year.
So this tax deferral will allow businesses to effectively enjoy their tax savings under the scheme 1 year in advance, if they so wish. And it will apply for expenditures incurred for year of assessment 2012 to year of assessment 2015.
Take a company that is to pay $200,000 in tax this year. If this company invested $80,000 on staff training, then it can defer $80,000 of tax to 2012, reducing this year's liability to $120,000. In 2012, when the company pays the $80,000 deferred from 2011, it can also claim up to 400% of $80,000 or $320,000 of tax deductions in its 2012 tax return.
I think the biggest issue last year was that people didn't quite understand how it worked. The value of the whole deal was not that huge. This year it's much better. It's been increased both in terms of the amount of money you can invest as well as in the return that you can get on it.
And with the government working with the chambers and trade associations, the take-up rate for PIC, analysts say, could increase.
Last year's strong economic performance will translate into higher pay for civil servants this year. Minister in charge Teo Chee Hean told Parliament annual salaries will return to pre-downturn levels and senior officers will get the maximum GDP bonus, with some getting as much as 8 months' pay.
Singapore's impressive recovery last year was soon followed by a tightening labour market. The civil service was not spared, with resignation rates as high as 17% among younger graduate officers. Deputy Prime Minister Teo Chee Hean outlined the need for competitive wages and said the civil service is restoring the cuts made during the downturn. Together with a special variable payment to be paid out in March, the annual salaries of public officers will, on the whole, return to pre-recession levels. The annual salaries of senior civil servants are automatically linked to GDP growth. Now, that's because they contain a significant variable portion, which is dependent on both the officer's performance as well as that of the economy. The more senior officers, such as ministers, have a more variable pay.
GDP bonus is zero if GDP growth is 2% or below, but accounts for a maximum of 1/4 of the annual salary of senior officers, or 8 months, when the GDP growth exceeds 10%.
After 2 years of not getting the GDP bonus, senior officers will get the maximum rate this year. On Monday, opposition MP Lau Tia Kiang had noted that estimated salaries for political appointments had gone up about 30%. Mr Teo said this reflected the design of their pay structure. He added that no changes had been made since salaries were revised in 2007.
Moving on.